Fiverr stock went absolutely parabolic back in 2020 and 2021, but now after a substantial decline, I believe it's worth another look. I'm going to tell you why I think that is, and if you stick around to the end, I'm going to give you my full valuation and tell you what I think it's worth. Welcome to the Stock Sale Flyer. My name is Aaron. None of this is financial advice. Let's get into it. So you can see the parabolic move on the chart here. There's some different reasons for this, I believe. For one, back in 2020, 2021, a lot more people were working from home. There was a lot of narratives in the news and things like that about people getting these gig jobs. The gig economy was something that was seen as sort of on the ascent and benefiting from the lockdowns and all the other things that were happening back then. And so Fiverr really capitalized on that in terms of its share price. And also it was being recommended by services like Motley Fool back then. So there's a lot of reasons why I think that it had this parabolic move that brought it up to as high as I think about $336 a share. So there were some different things on the back end of this working against Fiverr, I believe. One of which, obviously, people going back to work and the whole work from home narrative going away. There was also the fact that I don't think it was ever worth $336 a share. I didn't do a valuation back then, but I would be willing to bet that it was not worth anywhere near that amount of money. And on top of all that, Fiverr was also hit with some narratives like more in recent years, AI is going to replace the gig economy. And you might have seen things like this in the news talking about these gig economy jobs. These are going to go away because AI is going to take these jobs from them. However, we see that Fiverr has embraced AI and has made AI services pretty out there part of the business. We saw AI drove a plus 4% uplift in GMV when they reported their fourth quarter 2023 results. And the CEO of Fiverr went so far as to say, all in all, we believe AI will be a multi-year tailwind for us to drive growth and innovation. So you're seeing Fiverr embrace AI, and you're seeing this narrative change in the news as well. So you're seeing, at least I'm seeing, some headlines like this. So for in-demand freelance AI jobs, one can pay $100 an hour. There's incredible demand for people who are creative. This is from the same article. It said freelance marketplace Fiverr has seen this play out on its platform as well. Toward the end of last year, we started noticing spikes in searches around all types of AI-related needs. Fiverr is seeing AI as a tailwind for them, as a growth driver for them now. So instead of this narrative of AI is going to kill Fiverr as a business, Fiverr is embracing AI and making it a part of their business. When you go to the Fiverr webpage, you see AI services right there on the front of their webpage. So they're making this a key part of their business, so it seems to me. And I like that. They've taken something that was seen as a competitor to their business and they've just embraced it. And I think that that shows good management of the business, and it's something I like to see. On top of all of this, I think we're also seeing improving fundamentals for Fiverr as a business. So when they reported their fourth quarter 2023 key results, you can see here revenue was up 10.1% year over year for that quarter. Yes, active buyers were down 5% year over year, but spend per buyer was up 6% year over year. And they improved their take rate as well. One of the things I really like about Fiverr as a business is their gross margins. So 83.1% GAAP gross margin when they reported their fourth quarter 2023 results. Here you can see they've had consistent revenue growth over the past few fiscal years. And I highlighted that cost of revenue so you can see that gross margin on this as well reflected. And when you look at the diluted net income or loss per share attributable to ordinary shareholders, which I've also highlighted here, you can see that in 2023 they were profitable. So that is also another thing that I really like to see here. One of the things that's really been a drag on Fiverr's GAAP earnings per share has been the amount of share-based compensation that they've done. And you can see here that reflected on this reconciliation of GAAP net income or loss to non-GAAP net income and net income per share. You can see this right here. I've highlighted that line item of share-based compensation. So it's a lot of share-based compensation here. But there was some news that came out fairly recently that had me optimistic about where this was going. And that's that they announced a buyback or a board authorization of $100 million share repurchase program. Now, that doesn't mean they're going to buy back $100 million worth of shares. But if they've authorized this, if their boards authorized this and they're looking at buying back shares, to me, that means that they're hopefully at least looking at offsetting the dilution. And that, if they do that, could have a big impact on the EPS numbers from a GAAP perspective. So earnings per share being a driver of share prices, if they start offsetting some of that dilution, that could be big for the company, especially a company that does free cash flow, as you'll see here in a little bit with the valuation. One of the things I noted when I looked at the debt in the company is that their long-term debt, the vast majority of it was in these convertible notes that were issued back in 2020. They're due in 2025. So I wanted to kind of look into this because I was a little concerned that where they're convertible notes, this could lead to more shareholder dilution. But what I found when I dug into this was that it's likely that they're going to need to pay the principal amount in cash, as it says here. So I don't see this as resulting in much more dilution, if any dilution. I think it's just probably going to be converted into regular long-term debt. What interest rate they get there, we'll see if that's the road they have to go down with this. If I'm not interpreting this correctly or you have another perspective, if you're familiar with Fiverr stock, please let me know in the comments. But the way that I'm interpreting this is I'm seeing this as, okay, this is probably going to turn into long-term debt. The amount of debt they have doesn't scare me. I actually think the amount of debt the business carries is just fine. It's actually, I would almost consider it a strength that they don't really seem to have a ton of debt lagging the business. It's not like they have no debt, but it seems that they use debt as a tool and they use these convertible notes as a way to capitalize when their share price was ascending. And honestly, to some degree, that might just be them running the business effectively. So maybe it's actually a positive. I'm not going to go as far as to say it definitely is, but I wondered, is this just effective management? So here's the Fiverr valuation. I will say I am a Fiverr shareholder, and this one is a little bit more speculative than some of the other things I've valued on the channel. However, I tried to be, pretty fair with this, and it's a difficult business to value because it's still a maturing company. But I really did try to be fair with these numbers. You've already peeked at the fair value of equity. You can see the number I got there, and there's quite a margin of safety on that. And I would want one if I was going to buy more shares in this company. I haven't decided yet if I'm going to or not. I'm, pretty comfortable with what my average is right now. So I'm not sure if I'm going to buy more shares in this business, but I'm just wanted to say that it is a more speculative play. And if I was going to buy more shares, I would want to make sure I had a margin of safety. Now, that said, for total revenue, 2024 expected and 2025 expected, you can see I went with some analyst estimates from Ticker from May 5th, 2024. And then revenue growth rates going forward for 2026, 2027, and 2028. I took the average of 2023 and then the expected revenue growth rates for 2024 and 2025, and I just carried that forward. Net income, again, I looked at some analyst estimates and for earnings per share, I believe, and I tried to put together a number for this that was realistic. I've got a net income margin this year of 4.58%. Hopefully, they don't rely on share-based compensation maybe so much, so that you see an improving net income margin. And maybe there's some other factors that come into play besides the share-based compensation as well that help them improve their net income margin. But I would like to see them become more profitable and have a higher net income margin as they go forward. So I gradually increased this net income margin as I went forward into 2026, 2027, and 2028. Again, tried to get reasonable net income numbers. You can see the calculation I used to get these. So you can see the numbers I used for that. And then just gradually increasing that net income margin into 2026, 2027, and 2028. Hopefully, again, they just improve the net income margin of the business by having less of reliance on share-based compensation and some other things. If they do those things, it's possible these net income margins could actually accelerate and go up even faster than this. We'll see what happens. Again, it's hard to project, but I just wanted to at least gradually increase it because I think eventually the net income margins should come more in line with free cash flows and the expectations for free cash flows. You can see last year the free cash flow to net income free cash flow to net income here is quite out of line. And as the business matures, I would expect the free cash flow numbers to be more in line with net income. So you can see in 2024, I would expect them to grow their free cash flow. In 2025, I would expect them to continue to grow their free cash flow. So going forward, and then for 2026, 2027, and 2028, I use the same. It basically had the free cash flow growing in line with the revenue for those 3 years into the future. Perpetual growth rate, just 2.5%. I only went out 5 years with this one, but I almost think that's safer because it's such a difficult business to really value because it is a maturing company. Shares outstanding, I use the diluted weighted average shares from the 10K, as you can see here. Here are the numbers I used for my weighted average cost of capital. You can see the 10-year bond rate I used, the beta I used, the return of the market I used, market cap, all this. And then if you look at the fair value of equity, I got $45.89. Fiverr closed May 7th, 2024 at $20.95. What PE this will go for in 2028? I don't know. It depends on how the business is going. Is it growing rapidly? Is it not? Is it more of a small cap value company or a mid cap value company at that point? These are all going to be factors that go into what people are willing to pay for this company after the 2028 fiscal year, I should say. But you look at my prices at different PEs, if there's no change in the shares outstanding number I used, and PE of 15, $20.34, PE of 20, $27.12, PE of 25, $33.90, PE of 30, $40.68. I think that this is maybe worth a look again. At least that's my opinion. It's not financial advice. Do your own research, especially on these smaller companies. But I think that this one, where the sentiment around it has just been really bad because of the way it went parabolic and then just came back down. But you look at the way the business is going, the improving fundamentals, the way they've embraced AI. You look at how I think businesses will continue to hire freelance workers and people will continue to hire freelance workers. I don't think we're at a point where AI is about to just take away the market for all freelance work. I really don't. And there's always, in my opinion, probably going to be people who just want to hire somebody to do some work and don't want to deal with going in and typing in the AI prompts or doing whatever else they have to do to make the AI create what it is they want them to create. They may just want to hire someone. So that doesn't scare me away. I think that narrative on this one is a bit overplayed. I'm not going to say it's not a factor at all, but I'm completely comfortable continuing to hold my shares in Fiverr. And I'm interested to see where this one goes. Maybe it goes to zero. Maybe it does really well. I don't know, but I think there's a lot to like about the way the business is going. I'm interested in what you think about this one. Go ahead and drop a comment. Let me know. Click the like button, subscribe, click the bell to get the notifications. Follow me on X at Stock Sale Flyer if you haven't done that yet. Love to talk to you over there as well. If you got anything out of this video, please also share it if you know someone who might be interested in seeing what I'm doing on the channel. So thank you again whenever you're watching this video. And as always, take care.